Hi, and welcome to the second installation in our analysis comparing the USDA data, actually on this side, the USDA data on this side on the right, and the global trade data on the left. I want to bring up, before anything else, one omission from the last video where we're looking at the volumes. And it's a pretty important omission. In in the USDA, the information that they make available is for fresh blueberry market. It's the biggest market. It's very important, but they only make available fresh data through at least the AMS web data. That's what we host on Agronometrics. In the global trade data, we've expanded on that to include not only the fresh market, which for imports is the largest. Here you have some overview statistics. We also have exports, as was previously mentioned. We have processed. So we have both the imports and the exports of processed. And that can be further broken out into category, which in this case considers cultivated blueberries as well as cultivated wild blueberries, which is the technical industry term. That's a whole nother story. And then that information is also made available for the US markets is as conventional or organic. So you can kind of slice and dice this information as you wish. For the sake of this analysis, we're going to be looking at fresh, conventional, cultivated blueberries, which brings us as close as we can get to the information that the USDA makes available. So proceeding along, I promised that we're going to dive into pricing this time. So we looked at volumes last time, and we can scroll a bit further down the report. We can look at the last 18 months of pricing by origin. We've got the last 10 years of pricing by origin again, and then this year compared to the last 4 years. With the USDA data, we are looking at, so here you have the imports by origin. Right off the bat, a big difference with the USDA data that we mentioned in the previous video as well is the resolution of the information. So we get the USDA data daily and we publish yesterday's pricing. So then we aggregate it into weekly data points, which is what the industry usually works with. And that's how we come up with this report. From the global trade data, the information is made available monthly. So that's how you get the resolution on wild, processed, etc. That's how we get information on exports. The caveat, I suppose, is that it comes usually with a month or a month and a half delay. So at the beginning of the month, they publish the previous month's, so like kind of 2 months back data. So at the beginning of October, they publish August data. So at the beginning of November, they're going to publish September. Moving right along. Then we have for the USDA data, kind of the same chart. We're looking at this year compared to the last 4 years. And so we can kind of play with this. The charts are interactive. And this kind of helps at least talk about how the different seasons are, or how the different data sets are behaving. One thing you'll notice right away is this point is very, very high up. And that's something that we're not seeing in the global trade data. We're going to dive into this in a lot more detail here in a bit. There's good reason for that. And actually, let's start. Like that's really what we want to point out with this video is why is this point so much higher than what we're seeing in the global trade data. So to do that, we're gonna dive into the data set. We're gonna do that by clicking on this chart link button. And we're gonna do that by clicking on the open a live version of this chart here. That's going to give us to this chart. So we want to make something similar for the USDA data. So here we're looking at the last 78 weeks. We want to look at the last 18 months monthly. So period, monthly, period, monthly. We got the last 18 months. And now what we're going to want to do is the global trade data does not consider the local production. So the USDA, another great benefit of it is that they do track pricing for local production. So that's Michigan, Florida, California, Oregon, etc. But we need to filter it out to make the best comparison that we can between these two data sets. The way that we do that is go to trade flow, and we're going to look at imports. So that's already set up. And now these charts can start to look a little bit more similar. We're going to be able to get a better idea of how this has behaved in time. I want to look at not only the last 18 months, which we'll kind of go back to, but we want to look at a lot of history. We want to get a big overview of what's going on with this data set. And it allows us to kind of show off the service a little bit. So we're going to put in a 0 behind this and go 180 months on both data sets. So there's 180 months. So that takes us back to 2008. And then for the global or for the USDA, we're going to do the exact same thing. Here's 180 months, takes us back to 2008. You see another difference between these data sets is that the global trade data seems to have a lot more data points. It's at least noisier than the information that's available for the USDA. The reason this is the global trade data not only looks at the spot market. So the spot market is everything that's not sold on program. And that's what the USDA data is trying to represent. Usually that's between 10 and 20% of the volume. It can vary widely. But so a program, for those that aren't actually working in the industry, is a pre-established contract with one of the big retailers. So that'll be Walmart or Costco, for example. So say you're familiar with stock investing, that's like a long position. The spot market is a short position. So that's fruit that's sold and closed on the market today or yesterday of a high quality at a fixed price. So that is a transaction that actually happened, and that's how we're able to present like yesterday's pricing. It's an actual real price of what was actually happening on the spot market. With programs, you actually don't get that immediateness of the price. Like you pre-contract the price, you send the fruit over, and then there can be adjustments. They inspect the quality. If there's issues with the quality, then there's a note of credit issued, and the price can actually go down compared to what was originally negotiated. In theory, it can also go up. I just haven't heard of that. People in the industry can comment otherwise. But so in the import data, we collect all of it. It's spot, program, everything. It's a much more complete data set than what is made available in the spot markets, but the spot markets is immediate and we have the prices yesterday. So there's trade-offs for either data set. Now to compare these two, what we want to do is download the data, which can both be done with this button up here. And we're going to copy these together into an Excel and start looking at like what the intricacies of these movements actually look like. So we're going to go to download, and this comes up. This is the global trade data. So we're going to save it to that. Oh, no, I don't want to replace it. Actually, I want to keep the file that was there already. And we're going to do the same thing with the USDA. It's the exact same movement. It's the exact same data set. All of our data set is stored in the exact same way. So when you're comparing the two, you're actually comparing the same resolution, the same time period, so on and so forth. So you want to save it. I've already kind of set this whole thing up, so we don't need to necessarily replace the file. And then here's the global trade data file already set up. And the only one I'm really interested for the purposes of this video is the average. So we're going to copy the average, and I'm going to put it together into this file that I've already set up. And so just paste it. Because we've set up every data set the same way, when you say 180 months for both data sets, they're the exact same. So now we're going to look at the USDA data. We've got the average, same information, and we're going to put this together on the same sheet. And everything is equivalent, which makes data analysis a lot easier. Anybody that's ever had to like standardize data sets to work with them might appreciate this utility. To kind of make sense of this, what we want to do now is graph it. And I've already set that up. This is the entire data set. So this is going all the way back to October 2008 and bringing us all the way forward to September of 2023. We can see that these data sets, generally speaking, move in very similar ways. When there's a spike in one, there's a spike in the other, and similarly for dips. You'll notice that generally speaking, the spikes in the USDA are higher than the spikes in the import data set. This speaks to the mechanics of the spot market. I can go into a lot more detail on that if people want to, but it's going to make this video incredibly long. So we're gonna skip that and say there's differences. Spot reacts much more dramatically. And we're going to see how that kind of develops. Actually, I think I will explain it here in a little bit. We also see that previously the spot market ran, generally speaking, much higher than program. That could have been because companies preferred the security of importing to program as opposed to sending it over on the spot market. That has since been resolved. So now the spot market is very, very similar to program. And that's why the data set these last couple years have been much closer. But let's dive in. That previous one had a lot of noise. So here we get to see how we're looking at data from 2018 to 2023. We get to see how, generally speaking, they do follow each other. And generally speaking, the spikes in the USDA continue to be much higher than they are in the global trade data. So let me take the opportunity to explain that a little bit. So this is all based on expectations in the market. When programs are set up, they're set up ahead of time. So you don't actually know how much volume is actually going to market. And they set up programs based on one side. So exporters or producers set up programs to secure their business, make sure that they have enough sales to cover costs, etc. And that gives them the stability and consistency in the market. Spot market is more, you take the extra volume that you've produced, and that's kind of where you play with it. To not say gamble, but that's kind of, it's a short position. Like you get what the market's offering in that moment. So if the expectations for a harvest were, say, 10 or 100, just to throw out an arbitrary number, and the harvest is short, a certain percentage of that volume is going to be preset to program. So say 80. If the production is short, say 80, there's no fruit left to go to spot market. So all these companies that don't have these massive programs like Costco and Walmart, so say a mom and pop shop that just needs a couple boxes, they don't have where to buy fruit. So they're going to need to pay a premium to be able to secure any volume whatsoever. That explains a bit the situation, what's going on here with the spikes. But you also notice some points where the market, for example, so if we zoom in on this and look at the last couple months, where the market produces more than what was expected. So what happens there? What's the opposite? So say there was an expectation of 100 units of production. But really what was produced was 120. So then all of a sudden, you've already set up programs for 80 of that, but now 40 is on the spot market. And so the spot market is flooded. And to be able to move that volume, you need to convince that mom and pop shop or anybody that doesn't have a program, or even people that do have a program, to take on additional volume, to take on that additional volume. And you're gonna do that by discounting it. And so that's what happens when you see the USDA spot price fall below what's coming in at import, which includes spot and program. All right, so that's a bit going into the mechanics of the information and the comparison between the two data sets. I really tried to make this video concise. I'm not entirely sure I did a great job of that. Hopefully you're coming away with some interesting information. And at some point, I will hopefully learn how to edit this information down into bite-sized pieces that people can take in and make use of. In the meantime, I hope that this lecture on market movements is at the very least useful. All right, have a good day. Bye.